How does earning a 50% return every year sound? Well, the rule of 72 says our money would double every year and a half. Well, it is possible, and I've found a fund that has delivered on that for the last decade. I'm Skylar James, welcome back to the channel, and today we're diving into a leveraged ETF, specifically the SOXL ETF, which is the semiconductor index boosted by a 3x leverage. $10,000 investment 5 years ago in SOXL would be worth almost $250,000 today. In this video, I'll give you 3 questions you need to be able to answer before dipping your toes into the shark-filled waters of leveraged ETF investing. And I'll tell you why I think SOXL is a winner. Have you heard the phrase that semis are the new oil? Well, if you've watched my semiconductor shortage video, then yes, you have heard that before. If you haven't, well, you'll want to check it out. Semis are the new oil. Modern economies are dependent upon them to function. So as a durable good or as a product, the demand for semiconductors is strong. As an investor, I'm buying heavily and steadily into this sector. But let's go one step further. If you are bullish on a macroeconomic theme, if you're bullish on a specific sector, should you use leverage to maximize your returns? Today, we're gonna ask 3 questions about whether leverage ETFs are a smart tactical choice or just another get-rich-quick pitfall. Question number 1, are there macroeconomic tailwinds for this sector? For semiconductors, yes, without a question, there are tailwinds. And really, this should be a first question when evaluating any leverage sector ETF. And you'll see by the end of this video why that's the case. But remember, with semis, they're in everything, which is so cliche to say at this point. We're all a little numb to just how digitized and advanced everything is. So yes, strong, gusty tailwinds for the semiconductor sector, check. Question number 2, would you allocate a large portion of your portfolio to a non-leveraged version of these same holdings? Or said another way, for SOXL, do you already hold ETFs like SOXX or SMH in your portfolio? Or how about companies like NVIDIA, Intel, AMD, or ASML? If you're like me, then it's a yes to question number 2 as well, because SOXL contains those names, those same names that sit inside SMH and SOXX, and the same NVIDIA that's up 56% year to date. After all, question 2 really just asks, have you done your due diligence on these businesses? It's especially important to know that when you're buying before amplifying your reward and your risk by 3x. And the third and final question that you must say yes to, and it's the most important question, am I willing to sit with this thing through a strong downturn? 10%, 40%, even 60% drawdowns are possible in leveraged plays. This question is the most important one. Doesn't matter if we're talking about semiconductors, emerging markets, defense contractors, selling low will destroy your capital in a leveraged ETF. If you don't deal well with volatility, leveraged ETFs are not a good fit for you. Why is a strong stomach so important? Well, a 3x bull ETF goes up 3x versus the index on a good day. But it also goes down 3 times as much on a bad day. And remember, a 10% loss requires an 11% gain to return to break even. So review these 3 questions with me again. Tailwinds, yes. Are they companies worth investing in without leverage? Yes. And willing to hodl that leveraged ETF through downturns? Yes, times 3. Hopefully you got the same answers as me. What I've determined with these questions is that SOXL matches my investing appetite. Now that we're ready to invest, we're left with this big open-ended entryway. Do we buy it today? Tomorrow? After a pullback? After earnings? When? This is the $250,000 question. Take a look at these charts. The candlesticks are SOXL, and this is the 3-year look at the price action. The purple line on the left is SOXX from iShares, the unleveraged BlackRock Semi ETF. And for the chart on the right, the purple line is SMH from Van Eck. Under the hood, those two ETFs, SOX and SMH, have different holdings, but still match each other in returns. I'm showing you both of these charts just to prove that the two semi ETFs perform about the same compared to SOXL. So let's scrap SMH, it's one of my favorite ETFs by the way, and just focus on SOX versus SOXL. Here's a 1-year chart showing the performance of both funds. Notice right here we've got an inverse head and shoulders pattern. We've also got a nice wedge back here and a beautiful cup and handle formation that carried us out of February. Okay, I'm just kidding. Yes, these are technical terms, but this won't be a technical analysis. I do have an intro on technical analyses right here if you want to understand an introduction to common indicators. Instead for this, we'll focus on human psychology. When something is ripping to the upside at an all-time high like SOXL, do you get nervous about buying in? Thinking, hey, it's at an all-time high, maybe you should just wait for a pullback. Well, relax your nerves. Everything's going to be fine. At least that's what this chart from JP Morgan says. Regarding the S&P 500, had you pushed money in during the all-time high, you would have seen higher cumulative returns than had you pushed in your money on non-all-time high days. What? Yeah, investing at all-time highs leads to greater gains than not. Now, that's the S&P 500, not semi specifically, but you already know that the S&P is the standard bearer for investing, and investors would be smart to take note of this chart before investing anywhere in the market. Check out this other interesting chart from Fama and French. This is the return of the total US market. Had you pushed in money following a correction or a big dip, this is a slightly larger set of stocks than the 500 in the S&P because the total market loops in mid, small, and micro caps. Look at those 5-year returns after a big dip. Let's call it 68, 72, and 50% respectively. That's the 5-year return generated if you bought in at a 10, 20, or 30% dip in the market. Okay, we're looking at this to decide when to jump further into the deep end for the rip-roaring semi sector. Now, blend the two charts together. For the US market as a whole, after 5 years, investors saw the best returns by jumping in on a day when the market was already at an all-time high. The second best returns, and we're going to call this a tie, came from either investing after a 20% pullback or by investing on literally any given day. This is shocking, right? Knowledge is power, and this is very powerful knowledge. What this chart clearly shows is that as investors, we need to check our assumptions at the door and instead look at the numbers. Armed with these charts, I present you 2 ways to enter the SOXL trade. The first, follow the conclusion on the 2 charts. Buy SOXL on any given day, including all-time highs like we're seeing currently, but still use dollar cost averaging instead of pushing all your chips in at once. The second way you could enter SOXL is to pick a time frame, 3 months, 6 months, a year, something like that, and enter when the price of the leveraged ETF dips below the underlying index. Let's recap this thesis. We verified that semis are worthy of investing via a leveraged ETF. We verified that investing at all-time highs leads to a bigger return than investing in dips. And we see SOXL is far and away at an all-time high, though it has stalled a bit in the last 6 months. Here's my plan going forward. Over the next 25 weeks, I'll invest $10,000 in SOXL through dollar cost averaging. If I deploy my capital evenly, that breaks down to about $400 of purchases each week. At the time of this recording, SOXL trades at about 43 bucks. 10 grand would buy me 232 shares at this price. As the year goes on, anytime I see a share price 10% lower than it is today, I'll double the amount of capital I deploy that week. So if SOXL falls to 35 bucks, I'll buy $800 worth of shares instead of $400, and vice versa. If the share price rises 10% from this $43 point I've selected, I'll cut in half the amount of money I allocate that week, only spending about 200 bucks. I'll maintain this formulaic, disciplined buying till all $10,000 have been allocated. And hey, maybe this means only 5 years from now, this will turn into a cool $250,000. So what's your experience with leveraged ETFs? Do you hold them for the long term? Let me know in the comments below, and I'll see you on the next one. Leveraged ETFs are funny because they feel like an oxymoron. It's an ETF, so it's broader and offers more diversity. But then we have such a strong conviction that we invest aggressively through leverage. So it's an aggressive, somewhat diversified play. All right. Anyway, thanks for joining. Cheers.